What if everything you were taught about risk was wrong? What if the biggest danger in investing isn't volatility, but something far more subtle, far more silent, and already shaping your decisions without you noticing? In 2020, markets didn't just fall, they shook. They moved violently up and down almost every single day. Headlines screamed panic, charts looked like heart monitors in an emergency room, and millions of investors believed they were watching risk. But Warren Buffett said something very different. Volatility is not risk, and if you don't understand that, you may never understand how real wealth is built. Let's go back to 2020. The world stopped, businesses closed, airports were empty, fear was everywhere. Markets crashed fast, then they rebounded just as fast. To many people, that movement felt dangerous. But Buffett's 2020 shareholder letter carried a calm message beneath the noise. Price movement is not the same thing as business deterioration. Let that sink in. A falling stock price does not automatically mean a weakening company. Sometimes it simply means fear is spreading faster than facts. Here's the deeper point. Risk is not the fluctuation of a quote on your screen. Risk is owning something you do not understand. Risk is depending on an outcome you cannot evaluate. Risk is emotional decision-making disguised as rational analysis. In his letter, Buffett reminded investors that Berkshire Hathaway owns businesses, not ticker symbols. That distinction changes everything. When you own a piece of a real business, what matters? Cash flow, competitive advantage, management quality, long-term demand, not yesterday's price. In 2020, many strong companies became cheaper, but they did not become weaker. Factories didn't disappear overnight. Brands didn't lose decades of trust in a week. Customer loyalty didn't evaporate because the market was scared. Prices moved, but the core economics of many businesses remained intact. That's the separation most investors fail to make. They confuse volatility with permanent loss. Buffett has always defined risk differently from Wall Street textbooks. Academic finance often defines risk as price volatility, but Buffett defines risk as the probability of permanent capital loss. Permanent. That word matters. A temporary drop is uncomfortable. A permanent loss is destructive. And those are not the same thing. Imagine owning a farm. If someone offers you a lower price for your farm tomorrow, does that mean your crop stopped growing? Of course not. The land still produces, the soil still works. The value creation continues, whether or not someone is shouting a lower price. The stock market works the same way. It offers you prices every day, but you are not obligated to react to every offer. In 2020, the market offered many businesses at lower prices. Buffett's point was simple. Lower prices can increase opportunity if the business quality remains. The real danger appears when investors don't understand what they own. If you buy something because it's trending, because someone online recommended it, because the chart looked exciting, then volatility feels like risk because you have no foundation. But if you deeply understand how a business makes money, who its customers are, why it has durable advantages, then volatility becomes background noise. It may be loud, but it doesn't change the core reality. In the 2020 letter, Buffett also emphasized America's long-term resilience. He reminded shareholders that despite wars, recessions, crises, and political turmoil, productive businesses continue to create value over time. Short-term chaos did not destroy long-term progress. That perspective matters because markets amplify fear. But businesses compound value quietly. There is a psychological trap here. Humans are wired to react to movement. Fast movement signals danger in nature. So when prices swing wildly, your brain screams threat. But investing rewards the opposite behavior: calm, analysis, patience. The investor who understands the underlying business sees volatility as information, not instruction. Information can be observed. Instruction feels urgent. Most people treat price movement as a command. Buy now, sell now, do something. Buffett treats it as data, and that difference creates an edge. Another subtle insight from 2020. Liquidity and strength matter during crises. Berkshire entered the crisis with enormous cash reserves, not because Buffett predicts crashes perfectly, but because resilience requires preparation. Strength reduces real risk. Preparation reduces forced decisions. Many investors in 2020 were not destroyed by volatility. They were destroyed by leverage, by overconfidence, by owning assets they didn't understand, by being forced to sell at the worst possible moment. That is real risk, not movement, but fragility. If your financial structure cannot survive volatility, then volatility exposes your weakness. Buffett builds structures that survive storms, so when storms arrive, he remains standing. This is the deeper lesson. Volatility tests psychology. Understanding reduces fear. Financial strength reduces fragility. And patience transforms chaos into opportunity. Let's summarize. Volatility is movement. Risk is permanent loss. Volatility is emotional noise. Risk is ignorance. Volatility is temporary. Risk is structural. In 2020, many investors saw chaos. Buffett saw discounted future cash flows. Many saw danger. He saw resilience. Many saw red screens. He saw long-term productive capacity. And that mindset is not accidental. It's built on decades of discipline. But here's the uncomfortable truth. Understanding a business requires effort. It requires reading, thinking, saying no to opportunities outside your competence. That's harder than reacting to price changes, which is why most people never develop this edge. So the real question isn't, can you handle volatility? The real question is, do you understand what you own deeply enough to ignore it? Because if you don't, volatility will always feel like risk. But if you do, volatility becomes optional. In the next video, we're going deeper. Because Buffett didn't just redefine risk in 2020. He revealed something even more powerful, a framework for thinking about opportunity during crises, a way to prepare before fear hits, and a mental model that separates long-term wealth builders from permanent spectators. If you want to understand how real capital compounds through chaos, stay with me. The next lesson changes how you see every market crash forever.